Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Hello, everyone, and welcome back to another episode of Palisade Radio. It's Saturday, March 12th, the weekend following PDAC, and for those that weren't there, it was an exciting show. Attendance was a bit lower, if my guess is correct, but the excitement at the show certainly mirrored the action in the gold stocks for the past month and a half. And on that note, I am back in the Bahamas with my good friend David Skarica. He, of course, is at the time right now a market bear and a gold market bull. We've talked to him about this in the past, but not for a few months. David, welcome back on the program.
Thanks for having me.
Let's start off with gold. That's what's on people's mind. It's moving. Some people think there's going to be a pullback. You've indicated to me you do not see a pullback for quite some time.
Yeah, what I think we're in is if you look at the downtrend in gold, actually the most similar market I've seen to it is actually not a past gold market, but it's this equity market from 1980 to 1982, in that the stock market, the S&P or the Dow, had this very choppy downtrend, and then there was a lot of negative sentiment. And then the August of 1982, there was this huge breakout, and essentially the market went almost straight up for 8 or 9 months, and then there was a correction. In actually even over a year, the market went up, and then there was a correction in 84, and then you went up into the 87 crash. So that's what I see happening now. And basically what happened in a nutshell on that is there was basically a huge 4 to 6 month move in the stock market without a real big pullback. And that's what I'm seeing here in gold, is that everyone keeps thinking there's going to be this 20 or 30% pullback in the stocks, and gold's going to pull back to 1150 or something. And I don't see that. I see that, we were down $20 on the Friday before we did this episode on Friday, March 11th. But I don't really see this huge pullback happening. I see these very shallow pullbacks. And just like everyone sold into the rallies in the bear market, you're seeing them going to be buying the pullbacks. And one of the major factors, I think, is the commitment of traders, and all these things can still be used for trading gold. But because of the advent of these ETFs, like the GLD, one reason the gold went down for 4 years was the GLD had outflows for 4 years or 5 years. Now the GLD has had something like 40 or 50 straight days of inflows, which is a record. So when this money comes into the GLD, it then has to buy in the physical gold market. So until there's outflows in the GLD, it's going to be really difficult for gold to have a sustained decline. So that's what I'm seeing right now, is that, yeah, sure, can we go to 1230 or 1225? Yeah, why not, right? But I don't really see us having a huge pullback. And from what I'm doing in my newsletter is we're really mostly in these small Canadian listed miners that say have one resource or one property or one producing mine, because these are the stocks had the most leverage. Like I've now been through, even though I'm a younger guy, this is now my, I guess, third or fourth bull cycle in the gold market, and I've learned from the other cycles that in this kind of first move up, these smaller producers are the stocks that can go up 100, 200, 500, 1,000%, that sort of thing. So I'm tended to be more invested in them now. And I have small positions in some of the larger miners, but that's really where we've been. And we've already had a couple of these positions up 40, 50, 100% just in this first move of a couple months. And what's kind of funny is I have a large short position in the market. We did take some off when the market sold off, but we're re-adding to that now. But even with myself but gross, about 20 to 30% short, I'm still making a large amount of money in my portfolios because these smaller miners are doing so well.
As a side note, our friends over at Visual Capitalist just put together a great chart that came out last week. I think you could see that at visualcapitalist.com, showing the inflows into the gold-associated ETFs. It's been quite impressive, as David just noticed. And David, we were just talking earlier about how looking too closely right now might actually hurt you. For example, people really studying the technicals right now, you were saying, well, that doesn't really work when things are this oversold and the bottom's in, and people are looking for any excuse to wait to buy, and then they jump in to buy because they think they're going to miss the boat. Talk to me about the thought process that's going into creating this bull and how something like this could sustain for 3 or 4 months straight before having a sizable pullback.
Well, I think on the fundamental side, one of the key things that happened in the last couple months was when Japan went negative interest rates. Because, okay, I know that some places in Europe have it and blah, 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 but Japan is the second largest bond market in the world. So when their 10-year bond went negative for a little while, it actually meant that there was already something like $2 trillion of bonds in the world that had negative rates. But because Japan has so much debt and their 10-year bond market is so big, when that went negative, it jumped to like 10 trillion or something, right? So I think no one's going to want to buy a bond with negative rates. So this whole thing where, gold doesn't pay interest, well, gold is actually going to keep its value too. So that pushed people into gold. And I think it even helped the other metals, copper, iron ore, all had short squeezes. And I think these negative interest rates play a big, big role in this. And then even though it caused a short-term sell-off on Friday, the European Central Bank just went more negative. And I think that's something you're talking about people following technicals and this sort of thing. They're ignoring that we're kind of in this unique situation no one's ever seen before. Where we have all these negative interest rates. And negative interest rates means people want to return somewhere, and that really makes gold even more and more attractive. And then it works on the opposite side too, where when you have negative rates, it means the price of the bond is going higher. Well, people can say, what happens if the bond sells off 50 basis points in Japan or Germany? Well, guess what? That means the price of that bond will tank. So even if you can say, oh, I'm getting more interest, but anyone who owns the bond loses a lot of money when the rates go higher, and that actually makes gold more appealing now. So I think these kind of like bubble kind of conditions in these global bond markets are a big influx into the gold market. And I think that, again, a lot of the people who are just looking at technicals are kind of ignoring this kind of unique situation. And just so you know, I've learned from my mistakes in that too, is that I used to be, like 10 years ago, more of a technical guy. I'm actually much more of a fundamentally based investor now, because you see scenarios like this unfolding in one-time events like negative interest rates. And for example, all the financial engineering on the bear side in the stock market, you see these things that really technicals can't explain, and you either go short or long based on more of these fundamental phenomenons.
Yeah, I think negative rates are going to play a huge role here. Our friend Jordan over at the Daily Gold wrote a book talking about this a few months ago. He's been pretty on point. We just did an interview, if our listeners haven't heard it, with Itai Friedman that came out just a few days ago, and it's going to be one of our most popular interviews ever. It's just gaining a ton of traction, but he talks about, he's a super bear right now. He even thinks negative rates are going to come to the U.S., which of course they're now in Japan and Europe, which are the other two major instruments that people are looking at for treasuries. But he thinks it's going to come to the U.S. now. What do you think?
It's going to be a little more difficult to come to the U.S., and this is why there's been more reluctancy to bring them to the U.S. Yellen did mention it, but the problem is the U.S. has this huge, gigantic, like annuity and insurance industry. Obviously, there's insurance companies in Japan and Europe as well, but the U.S. even more so. So insurance companies need yield off long-term bonds to survive. So really, it's going to be much more difficult to do this in the U.S., but it could still happen, because one of the reasons for negative rates that no one never talks about is because these central banks lie, right? They say, oh, it's about inflation, it's about this. No, part of it is like Japan has debt to GDP at 250%. Many of the European countries, not just Greece, like Italy is well over 100% of GDP. Actually, all levels of government in the United States, including state and municipalities, U.S. is 130% of GDP. It's actually almost the same level as Italy. So when you take all levels of government, and so one reason you have negative rates is if rates went to 3, 4, 5% normalized, these governments, even at low rates like that, would almost basically broke. So a lot of negative interest rates is actually just to keep governments alive. And in the end, governments are going to do what they can to save themselves, as opposed to like the insurance industry, right? So I definitely think it could happen. It's going to be a little more difficult, again, because of the financial aspects of the American economy. I think like when you look at the two most financialized economies, it's probably the U.S. and the U.K., and that's why that's two of the places you haven't seen negative interest rates. And I think that kind of financialization, huge financial sectors in the economy are playing a large factor in us not getting negative rates. But again, if you get another downturn in the global economy, go look at what happened to the debt to GDP everywhere, from the U.S., from countries in Europe during the last recession, because the deficits widen. Obviously economic growth slows down. So if all of a sudden you go to 160, 170% debt to GDP at all levels of government in the U.S., you're going to want negative rates to kind of keep that system alive. And I think in the short term, you'll get it. But I think negative rates ultimately will kind of be the final nail in the coffin or top of the sovereign debt bubble. And probably will just take one country. Maybe it's Japan, maybe it's Italy, maybe even the U.S. bond market blows up first, because, the U.S., the disadvantage of being the reserve currency is when things get ugly, Japan and China are going to sell their U.S. bonds. So I don't know who's going to be first. I would think it'd probably be one of the large Western European or economies like Italy or Japan. But one of these bond markets is probably going to blow up, and that might start the sovereign debt bubble kind of unraveling. I don't see that in the short term, but I think that's where the negative interest rates will ultimately yield. But he could definitely be right. We can see negative rates before that happens, because the central banks basically make stuff up as they go along, and they change the rules as they go along. So they might do that as one final last like kind of desperation gasp.
Many investors, including yourself, have been prudent to stick with the majors at the beginning of this move. It's just looking at Barrick at the price it was. I know you had recommended buying some. You're up 100%, which is a crazy amount to be up in just a couple months on a major stock. Not to sound like a broken record, but I want to go back to the idea of investing in private placements and getting warrant exposure. I know that you made just a ton of money back in early 2000s with that strategy. And just to use an example of the amount of money that can be made, Pilot Gold just closed a financing a few days ago, and they had it done at 25 cents with a full warrant at 40, and the stock is already at 55, 60 cents. And so rather than just going over a little more 2 times your money, the people who participated there have already tripled their money. Just the type of gains that you can't make investing purely. And I know that you help some of your subscribers out with looking at private placements and whatnot, but talk to me just generally about getting involved in placements and why you see so much value there in a bull market.
Well, obviously I'm not like promoting these companies or anything, but if people are interested who are subscribers, I have a certain list that's a higher end list. If you ask me about it, and I can always tell people about something I'm doing or whatnot, and you can get into. But like the advantage is quite simply this: is like in a nutshell. Is let's say you have a 10-cent stock, okay, and then there's a warrant at 15 cents. It's really simple math. You buy $10,000 of the stock, 100,000 shares at 10 cents. The stock goes to $1. So you make 100, 10 goes to 100. Well, if you exercise that warrant at 15, it means that it costs you another 15,000 to also make that 100 for that to be 100. So all of a sudden then, instead of just buying stock at 10 cents and have it go to $1, so 10 grand to 100, basically then if you take on that new money, you've put 25 grand in the deal to go to $200,000. And you can even, of course, sell some of the stock at $1 and then rotate it and exercise the warrant. So you might still only have that initial 10 grand on the table when all said is done. So this is like really, really the way that more sophisticated investors and more can kind of play the market. And now, I have been very disciplined where, since the market kind of busted and really in 2014 and 2015, I didn't do one private placement because I just thought it was too early, right? But now I'm starting to get involved again, and because there's a trickle down effect, as you said, the majors go first, and these mid tier companies go, and then these smaller juniors will go begin to go up. I think really begin to go up when gold starts going through 13 to 1400. But anyhow, I think now is kind of the time to get in that mold. And like you said, yeah, and really in the last bull market, I made some money doing it, but really that 2002 to 2007 period, I made a significant amount doing that. And I think, like I said, it gives you this leverage. It gives you this ability to exercise and buy more shares. So, and the junior marketing, advantage of being in the States and Canada is probably the best junior market in the world is in Canada. So it's right there on your doorstep. And if you're American, you're also buying the dollar at 75 cents on the dollar. And it's a great way for an American to get exposure outside the US dollar. Because let's say, even though, I don't know, I'm not that bullish on oil right now, but if all resources begin to move higher, especially gold, the Canadian dollar probably ultimately will continue to drift higher to the 80 to 90 cent range. So also being in these private placements gives you exposure to that. But really, you don't care about that much. It's just more about making 5 or 10 times your money. And really, this is the time to do it. Because again, learning from my past experiences in bull and bear markets, I'm not going to be that interested in the private placement market when everyone else is, when the market's bubblish, when it's hot. But now, if we're right and we're in the early stages, this is like the first inning of this next phase up in the gold market. This is the time to start doing the private placements and really do them for the next few years.
Yeah, and I know that some of our listeners are quite sophisticated and participate in private placements themselves. If you ever have any further questions about that, feel free to just flip me an email at colin@palisadeglobal.com, or also send David an email and ask him for more information. Yep.
Oh, sorry. One thing I've done is I have a lifetime subscription for $2,500, and also I have a shorting service, and it gives you also a 3-year subscription to that shorting service. But also, what I'm going to do with this lifetime subscription, because most of the people tend to be more sophisticated or accredited investors, is that I will post like private placements that I'm doing there on the members page for that for those lifetime subscribers, and then you could write me back if you're interested or the whatnot.
Yeah, no, thanks for that. Okay, I want to talk to you about something not quite as gold specific. There's such a convoluted definition of inflation versus deflation. On the one hand, inflation is purely the fact that there's more money out there and it's not worth as much. On the other hand, people are claiming we've been in a deflationary scenario for the last couple of years, despite the fact that there's more money in almost every single currency, because you're multiplying it times the velocity of money. Your quote unquote inflation is lower. So there's no point in arguing the definitions of that. What I want to get into, there have been a lot of people that said gold and silver will go up, the other commodities will continue to go down because there won't be global growth. And I call BS on that. I've been saying that once gold and silver start to go up, my feeling is that since everything's gone down in tandem, and all that really means is that the price of the fiat currencies is lower, that in fact copper and iron ore and all these other industrial commodities will go up. And guess what? That's already shown that it's happening. We don't know if it's going to continue. I want to ask your opinion. Is gold the only place to be, or are you interested in these companies that are producing other commodities?
No, well, I think some of the commodities like iron ore that do, there was just a big short covering rally, but some of the commodities that do have big gluts like iron ore, they're going to take a little while because you got to work through that glut. Oil is the same way, right? But I tend to agree with what Milton Friedman, the famous economist, used to say about inflation. I don't agree with Friedman on everything, but I agree with him on inflation, where he says that inflation always is and will be a monetary phenomenon. And what he's basically saying is that if they print too much money, it doesn't matter if economic growth is weak. In every country that has hyperinflation, like Argentina had, or Venezuela right now, economic growth is weak. It's just that they're printing too much money, and there's too much money flopping around chasing too few goods, and prices go higher. So my feeling is that, and this was actually my feeling from all along in 2000 when I started getting involved in commodities, I didn't believe in the commodity super cycle or upcycle because of China and India. I believed it because all these Western governments are broke and will have to print money, and they'll create inflation to kind of inflate away their debt. So like, for example, Japan, which has been in so-called deflation, I say so-called because, go rent a 1-bedroom apartment in Tokyo for $4,000 a month and call that deflation, right? But anyhow, I say Japan, which has been in deflation for 25 years, usually these deflationary debt spirals end in hyperinflation. Actually, there was deflation in Weimar, Germany, before hyperinflation. So what I feel is in the next monetary kind of printing that goes on, right now this has been a financially induced bubble by monetary printing. It's all gone in the stock market. It's all gone into buybacks. It's all gone into cheap debt. That's how you got the big boom in fracking and that sort of thing. But the next time around, when that bubble ends and people realize, well, that didn't work, putting all this money into financial assets didn't work. I want to protect myself because, these companies can issue more debt. They can issue more shares. The central banks can issue more money. I want to be in real stuff. They can't print copper. They can't print gold. They can't print even oil and gas, even though there's a glut right now. So I think ultimately this and the next monetary cycle, it will all go into commodities, and people won't know what's happening. They'll say, well, China's slowing down, this is not doing well, blah, blah, blah. And I actually think when people say the commodity super cycle is at an end, they don't get that. They think it all had to do with India and China. In my opinion, it's going to have to do with monetary inflation. Also, look at it this way. In the 2000s, when we had this commodity boom, it wasn't just China. That was the peak of the dollar back in 2001. That was the first round of near zero interest rates under Greenspan during the housing bubble. And that also inflated the prices of commodities. And I think we'll see a scenario in the next move, more similar to the 70s, where you'll have this inflationary spiral in commodities due to the monetary printing and not really due to economic fundamentals. And by the way, these commodity indexes that they say they're going to 15 or 17 or 18 year lows, it's kind of BS because what's happened is they get reweighted all the time. So if oil and gas goes down 30%, it's reweighted back higher, right? And then it goes down another 30%. So that's the problem when you're reweighting all the time. Because give me one commodity outside of, say, natural gas that is below its 1998 low. Silver was like $4 then. Silver is still like $14, $15. Gold was like $300 then. Gold is, almost $1,000 higher. Even oil and gas bottomed in the mid-teens then. Oil and gas is north of 30. So every commodity is double or triple for the most part its 1998 low, yet these commodity indices are saying things are hitting 20-year lows. It doesn't make sense. So my opinion is this: if you go look at some of the other commodity super cycles, I'll quickly talk about one just to end off here. But the 30s and 40s, believe it or not, even though everyone thinks the 30s was deflationary and the Great Depression from 29 to 32 was, but actually there was a huge commodity boom from 1933 to 1951. And in the middle of that boom during the 37-38 recession, which is I think similar to what we're going to see here, there was this huge decline, took back almost all the gains of the move from 33 to 37. And then, when the money printing came in and World War II came in, and that inflated the prices of, created demand, for the war, for whatever, planes and tanks and blah, blah, blah. There was a huge commodity boom in the 40s. And I think we'll see the same thing here, where we're seeing this kind of bust, which is taking away a lot of the gains of the last 10 or 15 years. But then in the next move, when they print money again, you might see, you'll see a boom higher.
All right, and let's finish off with talking about the general market. Your newsletter actually has done so well the last few years because you haven't been invested in gold at the wrong time, and you've been really focused on the market, trading it up, and now you're really adamant, as was our guest a few days ago, Itai, that the market is probably about to enter a cliff event. I think you were talking the other day about the Roadrunner going over the cliff and looking down, and it's like just this huge drop. And there's so many reasons that could happen. I think last time that you came on the show, you told our listeners about Sotheby's, and you were short that. It was at like $35-$40, and it's down to low 20s now. So you've been able to pick out some good stocks, but really the crash hasn't happened yet. We've had a pullback. So are you still adamant that a crash is coming, and how soon?
Well, see, here's what I think. I don't think it's a crash like 87 and 29. One interesting fact that no one talks about, 87 and 29, both those crashes, and this is amazing when I tell you this, happened exactly 55 days after the market topped, which is unbelievable that 60 years later, it's, the exact same time frame for a crash to occur. But so a crash like that, when you have a parabolic blow off, they usually happen like that, like 2 months or so after the top. I'm looking at more like a bear market, almost similar to what the gold stocks went through, where the market basically spent a year or two topping out, just like it did from about late 2010 into, say, early 2012. And then in about mid-2013, there was a huge smackdown in the gold stocks. If you look at from about April 2013 to June 2013, the gold stocks fell almost 50% in just that 2-3 months. So what I'm looking for is we're still in this big topping formation between about 1,800 and 2,100 on the S&P 500. The actual numbers are about 1,810 to 2,130. And we're still topping out. Many stocks have rolled over much. Market's only off 5% from its top, but I can tell you a lot of the stocks I've shorted have fallen 20, 30, 40, 50%. So many stocks are down more than that. And even though they've come off their highs, all these FANG stocks, they're still, kind of in the stratosphere. So what I think is at some point, and I don't know if it's this spring, this fall, next year, we're going to have that big smackdown move where the market breaks the 1,800, and maybe the market, and just like the gold stocks, you have a 2, 3, 4 month whacking where the market can fall 20, 30% in that, right? And I think what will happen during that period is the market won't respond to monetary stimulus or fiscal stimulus or whatever, right? It'll be like 2008. It will just like really tank for that short period of time. But I think because of central banks, we just saw what Europe did. They're printing 20 billion more euros a month. They're doing negative interest rates. Japan, of course. The Fed won't hesitate to do QE again. I think what has to happen is we need some kind of event. And I don't know if the event is China devaluing in a big way, Deutsche Bank or something like that going under, energy debt causing mass, say bankruptcies in these regional banks in the United States. I don't know what exactly this event will be, but when you have an event like that, like a credit event, it's too big for the central banks to save right away, like 2008 was, right? So I don't know when it's going to be, but I do know that at some point we're probably going to get some kind of event where the ECB can't come in and say, oh, we're printing 10 billion more a month and the market goes up. No, it will like freeze up the system. And, you know, the Italian banks are in a lot of trouble too right now. So I don't know what it will be, but that credit event will probably be the event. And I don't know how gold will act during that event, but I can tell you out of that event, this is where we're talking about the inflation in all commodities. When they print more out of that event, that is when I think gold will just go completely gangbuster. So right now we have a shorting service where we're just straight up short stocks. I actually try to short based on totally fundamentals of companies. I look for companies with too much debt, who have declining business models, who are just using financial engineering to create earnings in their own fundamentals are slowing. So I kind of short these companies like the hell with the market. I'm just shorting this company because I think it can go down no matter what. And then if the market obviously drops, that, you know, increases the velocity and downward of the short. And then we also use put options and this sort of thing. So I think I'm very well balanced right now, where I do actually have some longs, regular longs. I look for beat up cheap companies. We have longs in the precious metals market. And then I'm still keeping a 20 to 30% short position. And let's say everything else, even the gold stocks went down 20, 30% in a major market meltdown. Well, I think that short position would go up, you know, 50 or 60%, and then that would like cut the losses, or even we can make money while the market, you know, kind of went down, you know, because like, for example, last note here, it's not just the guys in the big short. George Soros took a big short position during 2008, and he wasn't doing CDS. He was just, you know, hedging, you know, like shorting the actual market, maybe buying some put options. But Soros's fund still made a couple percent in 2008 because he hedged. And that is, by the way, how the real good investors really make money in the end. It's not huge gains. It's like, if you look at guys like Templeton or Soros or Buffett, they usually don't really outperform much in the bull markets. What they do, though, is in the bear markets, if the market drops 30%, they're flat or only lose 5%. So then they're set up for the next up move without losing a lot of money. So that is really kind of the key. I think hedging is a huge key. And I think just a quick note for your listeners, I know a lot of people now can become complacent if you are bullish precious metals, because now they have had a good move for a few months. But even if we don't see a 2008 scenario, even if we see the 01, 02 scenario where gold stocks go up while the market goes down, and the last leg lower in mid-2002, and I remember this because I owned gold stocks at the time, the HUI, which bottomed to 35, went to 160. It declined 40% in just a few weeks when the market just had the last smash lower. So it went to about 90 to 100. So all I'm saying is probably when that last smash comes, gold stocks will get taken down with everything else. So it's good, in my opinion, to have these hedge positions on.
Yeah, well, I appreciate that, David, and you can tell in your voice you're passionate about these shorts, and you actually call me a couple times a month, and you're really angry and upset about the financial engineering on some of these crappy companies that you find. So I would recommend everybody take a look at that. David's site is addictedtoprofits.net. David, any other comments that you have for our listeners?
Yeah, on the short side, because you talked, you know, that guest you had on talked about how he was shorting subprime autos. What I do is, because look, we're average people. We don't have access to credit default swaps and these sophisticated things, right? Or the capital. So what I do is I look for, like, I see, okay, there's a bubble in subprime auto lending, and I have a stock we were talking about earlier at breakfast that I have a short on, which is an indirect way to play the bursting of that bubble. And this is a stock that actually in every bear market the last 15 years has gone down 90% in value. It's a very leveraged company, and I can obviously give it away. But that's what I'm saying. If you're kind of interested in that sort of thing where, okay, you think this is a bubble or this is going to blow up, or like, for example, with people talking about the China yuan blowing up, there's actually a couple companies you can short instead of having to buy, no way you're going to buy credit default swaps in Japan or be able to do what Kyle Bass is doing and short the yuan. The average person just can't do that. But there's a couple companies that you can short that are multinationals, trade on the NYSE, and they're totally depending on on China for growth. So you short these companies, they devalue the yuan 20%, boom, that destroys a lot of these companies' profits, and they tank. So that's also a way. I give away the average investor can profit from some of these kind of things blowing up, which, because they can't use these tools that sophisticated investors can use.
That's right. And I think the title of this interview, David said it earlier on, this is just the first inning. The tides have changed. The overall market is not looking as strong, and gold stocks are really flying at this point. I don't usually promote anything, but for anybody that's not familiar, we also have a arm of our company called Palisade Research. You can find that at www.palisade-research.com. A lot of great content there. Thank you so much for tuning in, and many thanks to David for coming back on the show and giving us his insights.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?